Good morning, good afternoon, good evening. My name is Emma Henry, the CEO of Juve Trades, and I count it a very great opportunity to be the one to welcome you today. If this is the first time you're watching this video or you're visiting this channel, please do not forget to subscribe and also to click on the notification bell so that you can be notified when I upload a new video. Today I will be teaching you on how to trade boom and crash using moving averages. How to trade boom and crash using moving averages. I will begin by defining what a moving average is. Moving averages or a moving average is a trend indicator. Moving average or moving averages is a trend indicator. They help traders to understand what the price is doing. Now, moving averages do not determine the price. That is because they are a lagging indicator. Rather, they help to confirm the direction in which price is making. So, moving averages help traders to understand if the price is either in an uptrend or in a downtrend. Now, if the price is on an uptrend, for example, I'm looking for a strong uptrend example here. Okay, let me check crash 1000 because crash 1000 is on an uptrend. Okay, a typical example like this, we will see that the moving averages will cross each other, they will cross each other, and then they will tilt upwards like this example we are having here. However, if the moving averages have crossed, like in this example, at this point, if they have crossed at this point and then they begin to tilt downwards, it means that the price is making a bearish trend. It means the price is making a bearish trend. The first thing I want you to understand about moving averages is that moving averages helps a trader to determine if the price is on an uptrend like I just explained, or downtrend like in the case of Boom 500, or in a range. Now, when price is on a range, moving averages cuddle themselves. You can see this typical example where there is no clear direction, the price cuddles themselves. In other words, the moving averages cuddle themselves. When you see things like that, it means that the price is not making an uptrend or a downtrend. Rather, the price is ranging. How do you trade moving averages in a boom and crash market? The first thing I want you to know is that in trading boom and crash markets using moving averages, the first thing a trader should look for is the trend of the market. How do we determine the trend of a market using a moving average? It is by looking for a moving average cross. What by that? I am talking about something like this. A situation whereby moving averages, either your fast or your slow or your trend moving averages, cross themselves. In my case, I used the white. Let's go to our chart so that we can see. I used 3 moving averages. The first one is 220. It is exponential. Sorry for that. And then the brown is 220, whereas the blue is 120. The brown that is 220 is our trend, moving average. This 120 is what I use for my exit. I will explain that. And then I use the 20 period, which is our white 20 period moving average. All of them are exponential, which is our white, sometimes to determine entry and sometimes for crossovers, which is the main purpose of this video. So I confirmed, remember I said confirm the downtrend when my 20-day period moving average, which is the white, crossed over my exit moving average, which is my blue 120, and my trend, which is what, 220. And what happened after the crossover took place? We can see the massive downtrend that continued. Yes, there was another crossover at this point to show a little uptrend, which I call corrective move. Now, if you are a trader and you do not understand what a corrective move is, please kindly refer to my video, Price Action Strategies on Boom and Crash. There I've taken time to explain corrective moves and impulsive move. Now, corrective moves are simple pullbacks, what we call them pullbacks or retracements. In other words, they are counter trends that occur in or within the main trend. So if you have your bearish trend this way, we all know that bearish trend is a downtrend, and then you had a counter move, which is this buy period. This could call your pullback or retracement. So this little pullback that we had at this point here is just a retracement in the main bearish direction of the market. Okay, so at this point where we had the counter trend, we had a little crossover to signal a corrective move, and another crossover here to signal a corrective move. So anytime you are trading moving averages, don't play with the moving average crosses. That is because they help you to confirm the direction that the price is about to move into. Alright, now the second thing that you must do after you have confirmed the trend of the market using your moving average crosses is for you to use your moving averages to determine your entry and your exit. What do I mean by that? Moving averages act as dynamic support and resistance. For example, anytime the market is on a downtrend, like in this case here, our moving averages act as dynamic resistance. What do I mean by that? We had a crossover here, we had a trend here. What happened here was that we now had what? A pullback at this point. This pullback is what we call retracement, and it serves as what? Our period for entry. It serves as our period for entry. For example, if you look at the chart again, permit me to zoom it, you can see that the market did what? It broke our 20 period moving average at this point, and then it went down to the 200 moving average period, and at this point what happened? The market went down. So how do we enter the market? We wait for a pullback of this nature to take place, and then we enter. Somebody will say, which of the moving average period should I use for my entry? Well, you can use the 120, or if you're a little bit more conservative, you can use what? The 200. That is because at either of these moving average points, the price will reverse. For example, you can look at it at this point, the price reversed. Every time the market got to the 20-day period, the price reversed. So just be watch out and use that for your entry. And when should I exit? Anytime the price compromises the 120. Remember, I told you it is from an exit. That is because when the candles are above the 120, you will have another moving average cross, which will serve as what? Maybe a corrective move or maybe a change of trend. Now, looking at this market, you can see that we have what? A moving average cross here. The price moved down to the 200 and then what? Came down. And then the price has been rallying around this point since yesterday evening. Now, since there is no moving average cross here to confirm a change of trend, it will be safe for us to say that there is more than 65% probability that the price will continue to go bearish. What do I mean by that? Even if we check our M5, okay, we can see that there is still no moving average cross. So everything the price is doing at this point is what we call ranging. The price is trying to range here, and you can see the moving averages have been cuddling themselves. So if you are going to be a successful boom and crash trader who wants to trade with moving averages, the first thing is for you to always watch out for moving average crosses. The second thing is for you to use it as your dynamic resistance. If it's on a downtrend, it will serve as your dynamic resistance. And if it is on an uptrend, it will serve as a dynamic support. Let me look for an uptrend example. Okay, this is it. After the moving average crossover here at this point, okay, at this point, you can see that the market went what? It went bullish. Yes, you can see that when it went bullish, what happened? It came back to the moving averages, which acts as what? Our dynamic support at this point. And these pullbacks are what we use for our what? Entries. That is because once there is a confirmed moving average cross, precisely it may begin from M5, or if you are a conservative trader like me, M15. Enter the market and relax. Use a good risk management ratio. What do I mean by that? Be considerate with your loss size. That is because the market will not automatically put you in profit when you enter. For example, if you had entered at this pullback here, yes, the market will go up, but then look at it again. It came down and then went back up again, and then came down and then went back up again. So if this point was your entry, if you don't have a good risk management, you'll not be able to endure the little pullbacks, which might take maybe a period of 4 to 5 hours before it gets you to this price, which would have given you 100 pips. So if you are going to be a successful trader, don't just trade anyhow. Be considerate with your loss sizes and have a good risk to reward ratio. I will make a video on that, so just be on the watch out. So at this point, you can see how our moving averages acted as our dynamic support at this point, at this point, at this point. And then what happened? You can see the price went all way up until it came down here. And then what happened? We had another moving average crossover here. So be very, very watchful for moving average crosses, because they always signal either a change in trend or a pullback. If it is a pullback or a retracement or a counter trend, the market will get back to the original trend. However, be very careful. So somebody must say, when should I exit? For me, I always advise traders to exit after the price has gone below the 120. That is for you to secure the little profit you have made. So peradventure you had entered here when we had the moving average cross at this price. Let me check the price. At this price, 8266, and you had exited when it broke this moving average here. 8446, 8226, 8446, that is about 222 pips. If you are using one standard lot, that would have given you 222 US dollars, and if you are using what 0.2, that would have given you 44 US dollars roughly. So being conservative helps you to not just stay in the market, but it helps you to enjoy your analysis in a much more better way. It will also help you not to end your trades prematurely. So as you are going to trade moving averages, watch out for the following points: the moving average cross one, and then use the pullbacks, especially at dynamic points of resistance and supply, for your advantage. When you do these things, I'll see you succeeding. Always remember, don't be in a haste to rush into the market. Take your time, do your analysis, and as you do that, I'll see you on the top. If this video has been helpful to you, please do not forget to subscribe the channel and also to get the notification bell alert so that you will be notified when I upload a new video. See you on the top.